Hello traders, Gary Wagner here, 11:50 in Honolulu, 5:50 in New York on Wednesday, 12th day of April, 2023, and this is the daily report for gold and silver. Assumptions by economists, analysts, and market technicians that have been valid and insightful in providing meaningful clarification to understand the markets has undergone a subtle but profound change in terms of the complexity between the relationships of different forces. Gold, for example, for hundreds of years has been sensitive to inflation. But today, inflation showed a dramatic decline, one that has gone on for the last 9 consecutive months, and gold moved higher. On today's show, we will explain why that relationship has the nuances that cause the differential in the way we used to simplistically look at inflation versus gold and how we have to view it now. Gold had a nice moderate upside move, gaining 0.52% or $10.40, with the most active June contract currently fixed at $2,029.40. That's moments away from Australia opening up when we'll see the next changes. Part of that was directly attributable to dollar weakness. The dollar gave up 0.65%, and the index is currently fixed at 101.22. Lastly, the real performer once again has been silver. Silver has not been only resilient, but extremely strong, moving stronger to the upside in terms of percentage gains than gold has recently. Silver gained 44 cents in trading today, taking the most active May contract to $25.63. Traders, as you know, we were stopped out of our last trade. We were stopped out with a profit, $13 or $1,300 per COMEX contract, but it left me wanting in that my feeling was that it was an exaggerated move based on a holiday weekend that stopped us out. And I also believed that gold would continue to move higher. So it became a matter of where to place our next trade. When I saw gold hold above 2,000 yesterday, I really wanted to enter the market and enter it at the market, but my sense was that I did not have technical evidence that that price point would hold. As the day went on, I became more and more convinced, and so we put out a trade alert to buy June gold at $2,016.50 as a limit order, placing a stop at $2,008.90. That is these two lines here. I looked throughout the night, and the market was trading well above that, actually at some point at around 2030. I went to sleep feeling as though we missed the boat on that one. That changed when I woke up this morning and saw that we in fact got filled. We are currently trading long at $2,016.50. Our stop is at $208.90. The CPI data came down. It did show that inflationary pressures are being reduced, and the belief is that will moderate actions of the Federal Reserve. My recommendation is to maintain your current long position, maintain your current stop. We will look to move that stop up if and when the market moves up and gives us a little bit of wiggle room, so to speak. What I do want to do on today's show that has differed from previous days is concentrate and focus upon our exit strategy. As you know, over the last few months, I have presented various models. This is the most recent model developed on our most recent data. And what differs from what we have done before is we were looking at a potential breakout at this thrust. That has now occurred, and now we can factor in where we believe it could go. We're looking at counts and then fractional and then fractal counts behind it, this being the totality of our wave 4 and the conclusion of wave 4, moving us into a final fifth wave. We've then broken that up into its fractal subset. We believe we saw wave one. We had a series of compression triangles completing wave two right here. And we are now in a third wave scenario. Typically, when we compare wave one to wave three can go as high as 1.618, an extension of wave one. Of course, that will be subdivided into a 5 count, which is why I have these various price points, including the 61.8% retracement. So in other words, what I believe is inevitably at the conclusion of wave 5, we should end at minimum at $2,200. That is a 1.236 extension, or a 1.38 at 2241, and at best about $2,300, the absolute textbook model of a wave 3 extension based on wave 1. Now, there's many ways it could go, and I'm not even going to attempt to postulate a model as being what I believe to be the highest probability, but we could see this market move up to 88 or even as high as 2,000 and then break, move into its third wave, and then break, and then finish off at either the high of 2,088 or 2,041. In other words, we've got a series of peaks and valleys in between where pricing is and where I believe it will go to by the end of the third quarter or fourth quarter of this year. What I'm most excited about is every technical study, every fundamental set of issues that I look at are all pointing north. And that north is that gold will head higher, because although inflation is coming down, there are components that remain persistent or sticky. And we have a national debt that continues to grow. The Federal Reserve's balance sheet pays $750 million a day to banks that are holding their money. On top of that, we have a debt ceiling that we have to issue, and that is the tip of the iceberg, because geopolitical tensions, and God willing, none of them will actualize except for the continuing war in Ukraine. But what's going to happen with Russia as they do exercises in Taiwan? How crazy will North Korea get? And various other components that have created instability in terms of the geopolitical fabric globally. Therefore, I am exceedingly bullish on gold. This particular trade, I believe, is going to be a profitable one. I'm hoping, at least, and I believe we could look for anywhere between 2,088 to 2,000 as a reasonable upper level target. Maintain your current long position and maintain your stop. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.